Welcome to the Pro Ticker Deep Dive.
It's good to be here.
Yeah.
And frankly, looking at the screens today, good might be, a relative term.
Depending on what is actually in your portfolio.
Exactly.
So we have a massive amount of ground to cover today.
Yeah.
For context, it is Tuesday, February 24th, 2026.
Right.
And if you are just, glancing at the headlines on your phone.
Just checking the broad indices.
Yeah, looking at the S&P 500 or checking the NASDAQ composite, you might be forgiven for thinking everything is completely calm.
Mm-hmm.
We are flirting with all-time highs. The index level looks pristine. But if you actually pop the hood and look at the engine of this market.
It's a bloodbath.
Yeah.
There's really no other way to describe it. Underneath the surface, it is a bloodbath.
It really is. The street is calling it the AI scare trade.
Right.
And what is so disorienting about this exact moment is the bifurcation. It is absolute.
It's a massive split.
On one side, you have the hardware, the chips, the physical infrastructure, the builders,
Yeah.
right, holding up the entire index. And on the other side, specifically under the surface in software, there is a bloodletting happening that feels almost, it feels personal.
It's the syspocalypse.
The syspocalypse.
That is the term getting thrown around on the trading desks right now. If you pull up the iShares Expanded Tech Software Sector ETF.
That's ticker IGV.
Ticker IGV, yeah. It is down nearly 25% year to date, and we are not even out of February yet.
That is a crash.
Mm-hmm.
Let's just be very clear about that. A 25% drawdown in 2 months is a crash.
It is a crash, and it stands in stark contrast to the broader tech sector, which is only down maybe 5 or 6%.
Because it's buoyed by the semiconductor.
Largely buoyed by semis, yes. So this isn't a tech wreck in the broad sense like we've seen in the past.
Right.
This is a targeted assassination of a very specific business model.
And that is exactly what we are unpacking in our deep dive today. Because this isn't just about stock prices.
Yeah.
If it were just stocks, we could say, buy the dip and move on.
Right.
But this feels fundamentally different. This is about a battle for the future structure of the economy itself.
It's a structural shift.
We have this core conflict emerging today. On one side, you have intelligence displacement.
The bear case.
The bear case.
Yeah.
The idea that AI is coming to replace humans, replace software, and basically just eat the economic value chain from the inside out.
And on the other side, you have intelligence generation.
Right. Not the bull case.
The idea that AI is a tool, a utility like electricity that is going to expand the economy, create entirely new industries, and lead to this golden age of productivity.
And investors are stuck right in the middle of this fog of war.
It is thick right now.
It's so thick. You talk to one fund manager, and they say software is dead and buried.
A total value trap.
A value trap, exactly. You talk to another, and they say this is the buying opportunity of a generation, like picking up Amazon in 2001.
Right.
So our mission today is to cut through that fog. We are going to look at a dystopian scenario predicting a 38% market drop by 2028.
That's a scary number.
Very scary. We are going to deconstruct a concept called ghost GDP. And let me tell you, once you understand the math behind ghost GDP, you will not look at productivity numbers the same way again.
It is a fascinating, if somewhat chilling, economic concept.
And we're going to see why the smart money we are talking, the biggest hedge funds in the world, are aggressively dumping their AI winners.
The ones we thought were untouchable?
Untouchable, yeah. They are selling them to buy boring infrastructure.
Atoms over bits. That is the huge theme here.
Atoms over bits. And finally, we have to talk about agent-on-agent violence.
Which sounds like a sci-fi movie plot.
It really does. But it is actually happening in the microstructure of the economy right now.
It is the most disruptive force in capitalism since the internet.
Okay, let's dive into the scary stuff first. We have to unpack this 2028 global intelligence crisis scenario.
The displacement spiral.
Exactly. I was reading through the analysis of this last night, and it felt like reading a history book from the future.
Mm-hmm.
It outlines a scenario that is incredibly bleak.
It is a sobering read. It paints a very specific picture of June 2028. So we are looking just over 2 years down the road from where we sit today.
Right.
In this scenario, unemployment has spiked to 10.2%, and the S&P 500 has dropped 38% from the highs we are seeing right now in early 2026.
10.2% unemployment. I
Yeah.
just want to pause on that number for a second.
Yeah.
We haven't seen double-digit unemployment since the immediate shock of the pandemic.
Right, and before that, the great financial crisis.
But the scary part of this analysis is the mechanism. They argue this doesn't happen because of a sudden crash,
Right.
right?
No.
It's not an asteroid hitting the economy. It's not a pandemic lockdown.
No, and that is the nuance that makes it so insidious.
Okay.
It begins with what is being called corporate euphoria.
Corporate euphoria.
That is the phase we might actually be in right now, or just entering. Companies realize they can boost margins significantly by replacing white-collar labor with AI.
Right.
Productivity goes through the roof.
Yeah.
On paper, the economy looks stronger than ever.
Because the numbers look great.
Nominal GDP is printing high numbers, corporate profits are expanding, productivity metrics are hitting levels we haven't seen since the post-war boom of the 1950s.
So, stopping there, if productivity is up and profits are up, why is the market crashing in 2028? That sounds like a boom time to me.
Because it is a ghost GDP.
Okay, we need to break this down mechanically.
No.
Ghost GDP. It sounds like a buzzword, but there is real economic theory here. How does a GDP become a ghost?
Think about the components of GDP. It is consumption plus investment plus government spending plus net exports.
Basic macroeconomics.
Right. The biggest chunk, especially in the U.S., is consumption. The ghost element comes from the massive divergence between production and consumption.
Okay.
In this scenario, you have economic output, software writing code, agents handling customer service, AI generating marketing copy.
Things humans used to do.
Exactly.
Yeah.
That shows up on the balance sheet as high productivity and high profit because you aren't paying humans a salary to do it.
Right, your overhead costs absolutely plummet.
But here is the catch. Machines do not consume. An AI agent doesn't buy a house. It doesn't go to Disney World. It doesn't buy groceries or a new car. It doesn't pay income tax.
So you have supply going up, or at least the efficiency of supply is going up, but demand is just being hollowed out from underneath.
Exactly. And this leads to a complete collapse in the velocity of money.
Let's get technical on this for the listener. The velocity of money is a classic economic formula.
Right. Velocity equals price times quantity divided by the money supply. But in simple, real-world terms, it measures how many times a single dollar bill changes hands in a given year.
How fast money moves through the system.
Yes. In a healthy economy, I pay you for a service, you take that dollar and buy a sandwich, the deli owner takes that dollar and pays the baker, and so on. That velocity creates broad wealth.
But in the displacement scenario...
In the intelligence displacement scenario, the velocity flatlines. A company saves a massive amount of money on payroll by, say, firing 1,000 mid-level managers.
Right.
They take that saved capital, and what do? They don't pay it out to employees who spend it at the deli.
They reinvest it.
They buy more compute. They buy GPUs. They pay for server time and tokens.
So the money goes from a broad base of consumers into a very narrow funnel of hardware providers.
Correct. It gets trapped in the capital expenditure layer. They are buying infrastructure to protect their newly inflated margins. But by doing that, they are inadvertently destroying their own customer base.
Because if you fire the humans, who is left to buy the product your company makes?
It becomes a displacement spiral.
A displacement spiral.
That is the core risk. AI capability improves, so companies cut payroll. Consumer spending softens because people are unemployed or underemployed. Revenue dips. So what does the CEO do to keep the stock price up and protect margins?
They buy more AI to cut costs even further.
Exactly. It is a feedback loop with no natural break.
That is terrifyingly logical. And it's basically the Henry Ford problem in reverse.
Mm-hmm.
Ford realized he had to pay his workers enough so they could actually afford to buy the cars they were building. This new model assumes you don't need workers at all to buy the software.
And that brings us directly to why SaaS stocks, software as a service, are getting hammered specifically right now. Because for the last 15 years, the entire business model of the software industry has been per seat.
The seat-based model. This is the bread and butter of the B2B tech world. You pay Salesforce or Microsoft or ServiceNow or Zoom a monthly fee for every single human employee who has a login.
Right. But if you fire the humans,
You cancel the seats.
this is the reflexive loop that analysts are identifying. If a company uses AI to automate 15% of its workforce, by definition, it also cancels 15% of its software licenses.
Wow.
The technology that helps the client, the AI, directly hurts the software vendor's revenue.
I want to challenge this, though. Aren't these enterprise contracts usually long-term? Can a company just call up and cancel 15% of a Salesforce contract overnight?
You can't cancel overnight, no, but you can at renewal, and that is what the market is aggressively pricing in right now. Investors are looking at annual recurring revenue, ARR, which is the holy grail metric for software valuation. And they're realizing that in an AI world, that revenue might not actually be recurring. There's this devastating realization in the market that ARR might actually just be revenue that hasn't left yet.
Ouch. Revenue that hasn't left yet. That completely re-rates the valuation models. If you can't count on the renewal, you absolutely cannot trade at 10 times revenue.
Precisely. It turns pricing negotiations into a massive race to the bottom. If I am a software vendor and I know you're cutting heads, I have to lower my price desperately just to keep you as a customer.
Right.
Or I have to try to pivot and charge you for the AI usage, which is a totally unproven business model compared to the steady, predictable seat model.
And it is not just the pricing power. It is the moats. We always talk about economic moats. Those are the competitive advantages that protect a business from rivals. The argument here is that a lot of these moats were just illusions built on human laziness.
Human friction is the term I prefer to use. Think about your own consumer behavior. Why do you use the bank you use? Or the insurance company?
Yeah.
Or even the travel booking site?
Honestly, because it is a huge pain in the neck to switch. I don't want to fill out the forms. I don't want to spend my Saturday comparing 50 different rates. I just stick with what I already have.
Exactly. Your laziness is their profit margin.
Yeah.
Humans have limited time and limited attention spans. We rely on brand familiarity and we succumb to inertia. But an AI agent.
An AI agent has zero inertia.
An AI agent finds nothing tedious. It has perfect information. It can fill out 1,000 complex forms in a millisecond. This is where agent-on-agent violence comes in.
Let's walk through a concrete example of this.
Yeah.
Because violence is a very strong word to use in finance.
It is economic violence, total margin destruction. Take the real estate market. Historically, there is a 3% buy-side commission.
Right.
Why? Because finding a house, scheduling the tours, negotiating the offer, doing all the back-and-forth paperwork that is hard, tedious work for a human being, a human agent earns that 3% by navigating that friction for you.
Makes sense.
But in this new scenario, AI agents use decades of transaction data. They can assess the value of a home, draft the legal offer letter, schedule the inspection, and compare it against every other listing in the state instantly. The prediction is that buy-side commissions will compress from 3% down to under 1%.
That wipes out an entire industry's margin basically overnight.
Or look at food delivery, DoorDash, Uber Eats. Their primary moat is that they are a convenient app on your home screen. You are hungry, you tap the orange icon. You are too lazy to check 5 different apps to see who has the lower delivery fee or the faster route.
Definitely guilty of that.
But an AI agent doesn't have a home screen. If you tell your personal AI, get me a pepperoni pizza, it doesn't just go to DoorDash by default.
Right. It has no loyalty.
Exactly. It checks DoorDash, Uber Eats, Grubhub, and the local pizza place's direct website simultaneously. It finds the absolute lowest fee and the fastest delivery time. It bypasses the brand loyalty completely.
So DoorDash loses their pricing power. They just become a dumb commodity utility.
Right. Exactly. The brand tax disappears. If you are charging a premium just because you are the default option on a human's phone, AI destroys you.
And finance. What about credit cards?
This is the really big one. Think about credit card interchange fees. That 2 to 3% toll booth every single time you swipe a card.
That's huge volume.
Massive. That money funds the rewards points, the cashback, the whole airline mile ecosystem. Merchants hate it, but they pay it because it's the only way to accept digital payment easily.
Right. It's just the cost of doing business.
But agents can route around that entirely. 2 AI agents, one representing the buyer, one representing the seller, can execute a transaction using stablecoins or direct bank-to-bank transfers or new payment rails that cost fractions of a penny.
So the tour booths of the economy get dismantled.
They get dynamited. And if you are American Express or Capital One and your entire business model is built on that friction, on defending that 3% toll that is a structural crisis, that is why the market is scared right now. We are looking at the potential end of the middleman economy.
Okay, that is the bear case. And I have to admit, when you lay it out sequentially, like that ghost GDP, displacement spirals, the death of the toll booth, it feels incredibly inevitable. Feels like the math just naturally works out that way. But we have to look at the reality on the ground right now. It is February 2026. The world hasn't ended yet.
No, it hasn't.
So is this actually happening, or is the market just hyperventilating? Because there's a lot of analysis out there warning about mistakes to avoid when buying the dip.
Hmm.
Some people are looking at these software stocks down 25%, and they are salivating.
And the number one mistake analysts are highlighting is anchoring bias.
Anchoring bias. That's assuming the price should naturally revert to what it was 6 months ago.
Correct. You look at a stock that was trading at $300 and is now at $200, and your brain automatically says it's on sale, it's cheap. But that implicitly assumes the $300 price was the correct fundamental value. If the fundamental reality of the business has changed, if the moat is eroding like we just discussed with the agents, then $200 isn't cheap. It might still be wildly expensive.
It could be a classic value trap.
Exactly. A value trap is a stock that looks cheap by traditional metrics, a low PE ratio, maybe a high dividend yield, but is actually just a dying business. Think about buying blockbuster video stocks in 2005 because they look cheap. You catch a falling knife.
And we have specific, very real catalysts driving this fear right now.
Yeah.
It's not just theoretical. Anthropic just released Claude Opus 4.6 this month.
And that release was an absolute game changer for investor sentiment. We talk about AI models evolving all the time, but Opus 4.6 is fundamentally different. It has plugins for legal and coding applications that are completely native to the system.
So it's not just chatting.
No, it can run complex financial analyses. It can create and heavily edit multi-layered enterprise documents. It effectively challenges the core functionality of existing, very expensive enterprise software.
So if I'm a mid-sized law firm and I used to pay for specialized legal software to review basic contracts.
And now Claude Opus 4.6 does it better, faster, and for a flat subscription of $30 a month, why on earth are you paying $50,000 a year for the specialized legacy software? That is the exact question keeping enterprise software investors up at night.
But then we have to pivot. We have to look at the other side. Because if the bear case was 100% true, every software stock would be trading at zero right now.
And they aren't.
They aren't. We have real counter evidence in the market. Let's talk about Adobe.
Adobe is a fascinating counterpoint to the death of software narrative. They just reported their Q4 FY25 results, and frankly, they blew the doors off the estimates.
Record revenue of $23.77 billion. That certainly doesn't sound like a dying company being displaced by AI.
It isn't. And here is the key metric that actually matters in that earnings report: generative credits. This is how Adobe monetizes their internal AI usage. Usage of these credits increased 3 times quarter over quarter.
So people aren't just buying the legacy software. They are actively using and paying for the AI features baked inside it.
They are devouring them. And look at the Acrobat AI assistant specifically. Usage was up 4 times. This data firmly supports the argument that AI isn't just a pure replacement for software. It is a massive value-add feature that professionals are highly willing to pay for. Adobe is successfully monetizing what we call the intelligence agent model.
So they aren't waiting around to be disrupted by Anthropic or OpenAI. They're becoming the disruptor from within.
They are seamlessly integrating the agent into the daily workflow.
Yeah.
If you are a designer already in Photoshop and the AI is right there and it's highly competent, you use it. You don't go out to a separate window for Claude or ChatGPT. The workflow itself becomes the moat.
And Salesforce is attempting the exact same pivot right now, right?
Agent Force, that is their new platform. Mark Benioff is basically betting the entire farm on this concept. They reported that Agentforce is already handling hundreds of thousands of customer conversations with an 84% resolution rate.
84% resolution without a human ever touching the ticket. That is staggering.
It is, and Benioff is strategically framing this as a shift from software as a service to service as a software.
Break that distinction down for me. Service as a software.
Think about it this way. Software as a service means I sell you a tool, a CRM dashboard, and you have to hire human beings to use it to manage your customers. Service as a software means I sell you the outcome. I don't sell you a tool for your human agents. I sell you the agent itself. I sell you the successfully resolved customer complaint.
That is a massive paradigm shift. You aren't selling shovels anymore. You are just selling the holes.
Correct. And if companies like Salesforce and Adobe can pull that off, if they can capture the economic value of the human labor they are replacing, then their revenue doesn't go down. It goes up exponentially.
Yeah.
Because the global labor market is much, much bigger than the software tool market.
That is the glimmer of hope here. That is the corporate reality on the ground. It is mixed. It is not a uniform extinction event for all software. It is a rapid transformation.
Which brings us perfectly to the bull case. If you are optimistic, if you are actively ignoring the displacement doom and gloom, how do you look at this current market carnage? You have prominent people like Brad Gerstner at Altimeter and Jensen Huang, the CEO of NVIDIA, saying this is actually the biggest economic opportunity ever.
They call it intelligence generation.
Right. And the historical analogy they lean heavily on is the interstate highway system.
I have heard this comparison floating around.
Hmm.
Walk us through how that applies to AI compute.
So big tech, Microsoft, Google, Meta, Amazon, is projected to spend over $500 billion in CapEx in 2026 alone, just on AI chips and data centers. To a lot of skeptical investors, that looks like a massive bubble. It looks like gross waste. It looks exactly like the dark fiber optic bubble of the year
You're
2000.
building all this capacity that nobody is actually using yet.
But Gerstner and Huang argue this is foundational infrastructure building. Think about the 1950s under Eisenhower. The U.S. government spent billions building the interstate highway system. At the time, you could have easily argued, we don't even have enough cars to fill these massive multi-lane roads. It's a waste of concrete.
But the existence of the roads created the demand.
It created the entire modern economy. It allowed for the invention of the suburbs, long-haul trucking, fast food chains, roadside motels, mass domestic tourism. A whole new physical economy blossomed simply because the friction of transport collapsed.
So the argument is that by building the intelligence highway, by making digital intelligence cheap, fast, and abundant, we will create new industries and use cases we literally can't even imagine yet.
Exactly. We are currently stuck in the fog of war. Gerstner talks about this explicitly. Software valuations are severely compressed right now because of uncertainty. Investors historically hate uncertainty. They can't accurately model what 2028 looks like, so they just sell first and ask questions later. But he argues that this exact discount creates generational bargains in the top-tier firms.
Because the intrinsic value is still there.
The value is there, and potentially expanding infinitely. This brings us to token economics and the Jevons paradox.
I love the Jevons paradox. It is one of those counterintuitive economic rules that just makes you sound smart when you bring it up.
It is absolutely essential to understand here. William Stanley Jevons, back in the 1800s, observed coal usage in England. He noticed that as steam engines became more technologically efficient, meaning they used less coal to do the exact same amount of work, total coal consumption didn't go down. It actually went up exponentially.
Because the energy became cheaper, so people found entirely new uses for it.
Precisely. If you make artificial light cheaper, people don't just spend less money on candles. They light up their whole house, then they light up their street, then they build a baseball stadium and light that up.
So applying that directly to AI,
the underlying resource here is intelligence. Right now, human intelligence is expensive. Hiring a lawyer, a senior coder, a copywriter, that costs a lot of capital. But if the cost of intelligence measured in AI tokens falls to near zero, demand for it will go to infinity.
we will use intelligence in places we never thought to use it before.
Every single email will be optimized, every meeting note cross-referenced, every piece of code audited instantly, every basic design tested perfectly. Your refrigerator will have intelligence, your shoes will have intelligence. The total addressable market expands infinitely because the historical constraint of cost is completely removed.
That is the ultimate bull case. We are just seeing the construction phase right now, the dusty, messy phase of laying the concrete, not the usage phase yet. And valuations have actually normalized to reflect this, right? We aren't trading at 2021 multiples anymore.
No, we aren't. Look at the hard data. Software multiples, price to revenue dropped from a peak of about 6.7 times in 2021 to around 3.1 times in early 2026. The speculative froth is entirely gone. The market is pricing these companies strictly on profitability and free cash flow now, not just growth at all costs. So if you firmly believe in the highway thesis, if you believe in the Jevons paradox playing out, you are buying the dip right now with both hands.
That sounds very compelling, but I have to play devil's advocate here. Are the big funds actually buying the dip? Because we track the smart money closely on this show, the major hedge funds. They're moving towards $5 trillion in total assets. And when we look at their recent 13F filings, they aren't buying the software dip. They're doing something else entirely.
It is the great rotation, and it is, frankly, startling to watch. We really need to talk about Co2 Management, Philippe Lafonte's fund. These guys are legendary tech specialists. They weren't macro tourists dropping in. They know this specific space better than almost anyone.
And they have been aggressively selling their biggest winners.
Specifically, the Magnificent Seven names. Specifically, NVIDIA and Meta. Coty sold 82% of their NVIDIA stake and 53% of their Meta stake from the recent peak.
Wait, pause right there. They sold 82% of NVIDIA, the undisputed king of AI. The company literally making the shovels for the entire gold rush.
They did.
That seems almost insane given the bull case we just spent 10 minutes discussing. Why would they do that?
Simple risk management and valuation discipline. When a stock goes completely parabolic, it becomes a massive, unmanageable percentage of your portfolio. If Nvidia drops 20% on a slight earnings miss, it destroys your entire year's performance. They are concerned about a localized AI bubble in the hype names. They want to lock in those massive, life-changing profits. But the real story isn't that they sold Nvidia, it is where they chose to put that money
Where
next.
did it go?
Into the physical layer, into atoms, not bits. Their new #1 holding is TSMC, Taiwan Semiconductor Manufacturing.
It's a chip manufacturer. The pure play foundry.
The foundry. The thesis is beautifully simple. If AI grows, you need chips. If AI fails, you still need chips for literally everything else. Cars, smartphones, missiles, refrigerators, toasters. It is the ultimate asymmetrical pick and shovel play. It is the unsexy choke point of the entire global economy.
But hold on, TSMC.
Hmm.
With the current geopolitical tension in the Taiwan Strait, that feels incredibly risky from a macro perspective.
It is risky, but hedge funds are essentially betting that the world cannot afford to let TSMC fail. It is too structurally important. It is a calculated, high-stakes bet on mutually assured economic destruction. If TSMC goes offline, the global economy stops within weeks, so they are betting it stays online.
So they are moving away from the ephemeral software layer, the bits, and moving heavy capital into the hard physical reality of the supply chain, the atoms.
Yes. They are also heavily buying Synopsys, which makes the essential chip design software, and Applied Materials, which builds the actual complex equipment required to manufacture the chips. They are buying the infrastructure builders, the people who manufacture the concrete for the highway, not the people dreaming up the cars driving on it.
And we're seeing this rotation bleed into commodities too, right?
Absolutely. Multi-strategy hedge funds are quietly building out physical commodities, trading desks, natural gas, base power, copper. Because AI data centers require truly massive amounts of baseline electricity. You cannot prompt electricity into existence.
You cannot prompt electricity into existence. I love that line. You can have all the beautiful Python code in the world, but if you don't have the electrons flowing, it means absolutely nothing.
Exactly. You need atoms. You need physical copper wire. You need natural gas pipelines. You need massive liquid cooling systems. These are hard physical constraints. And in a world of infinite digital abundance, physical constraints become the most valuable assets on Earth.
There is a striking geographic split happening alongside this, too, which I find fascinating as a global investor.
A huge divergence. While U.S. software stocks are struggling and dragging down tech-heavy portfolios, Asian markets, specifically Taiwan and South Korea, are steadily rising. The MSCI Asia Index is having a remarkably great start to 2026.
Why the sharp split?
Because those specific markets are very heavy on hardware and advanced manufacturing, the builders, Samsung, TSMC, SK Hynix, and they are very light on SaaS. They don't have a lot of sales forces or workdays in their indices. They are currently viewed by global capital as a sanctuary from the AI displacement story.
That makes total sense. If you believe software is getting disrupted by AI agents, you hide your money in the countries that physically manufacture the hardware those agents run on.
It is a classic flight to safety, but the definition of safety in 2026 means owning physical goods and manufacturing capacity.
Okay, we have thoroughly covered the bear case, the bull case, and the smart money rotation. But we urgently need to talk about the systemic risks hiding underneath all this. Because if this bear case plays out even a little bit, if enterprise software revenue drops, if pricing power erodes slightly, there are some massive landmines buried deep in the financial system.
The biggest one by far is the private credit bubble.
This is the $2.5 trillion market that nobody in mainstream media talks about enough. It's opaque, it's not traded on public exchanges.
Right. Over the last 5 to 7 years, private equity firms went on an absolute debt-fueled buying spree. They bought hundreds of mid-tier software companies, and they took them private via leveraged buyouts, LBOs.
Explain the basic mechanics of that for the listener who isn't a Wall Street pro.
Essentially, a PE firm buys a software company, say for $1 billion. They only put up maybe $400 million of their own equity, and they borrow the other $600 million from private credit funds. They load that massive debt directly onto the acquired company's balance sheet.
And the company itself has to service and pay off that debt using its own operating cash flow.
Correct. And these loans, often structured as unitranche debt, were aggressively underwritten based on the assumption of annual recurring revenue. The lenders looked at the software contracts and said, this revenue is incredibly stable, it's recurring essentially forever, so we feel safe lending you 6 or 7 times your annual earnings.
But if AI agents suddenly disrupt that sticky revenue,
If the recurring revenue suddenly stops recurring, the math fundamentally breaks overnight.
the analyst report we looked at calls this the Zendesk scenario.
A hypothetical scenario, but a highly plausible one. Imagine a company like Zendesk, which was famously taken private with massive debt a few years ago. If their revenue drops just 10 or 15% because corporate clients replace human customer service software with AI agents, they might not generate enough free cash flow to even pay the interest on their massive loans.
They just default.
They default. And here's the truly scary part. Who actually holds that private debt? It's
Right.
not just big Wall Street banks taking the hit. It is insurance companies. It is conservative asset managers. It is state pension funds. It is Main Street retirement money heavily disguised as permanent institutional capital.
So if these leveraged software buyouts start blowing up, it directly hits your teacher's pension. It hits your monthly insurance premiums.
And there is a massive credit wall coming fast in 2027. A highly significant portion of this software debt matures and comes due next year. They have to refinance it. But if software valuations are low and interest rates are still relatively high and top-line revenue is looking shaky, nobody is going to refinance them.
It's a cliff, a systemic cliff.
It is. We could easily see a rolling wave of defaults in the private software sector that violently spills over into the broader financial system. It has the potential to be the subprime of the corporate debt world. Loans heavily made on the arrogant assumption that software revenue never goes down, just like the assumption that housing prices never go down.
Speaking of housing, there's one more vital connection here. The Citrini report touched on the residential housing market, specifically for high earners in tech hubs.
The high earner crisis.
Cool.
This is a fascinating second-order effect of AI. Think about modern mortgage underwriting. If you are a senior software engineer living in San Francisco or Seattle or Austin, making $300,000 a year, the bank happily gives you a massive mortgage. They give you $1.5 million to buy a house because you have a stellar credit score, 780 plus, and a quote-unquote stable job in a perpetually growing industry.
But if AI rapidly compresses white-collar tech wages,
If that 300K job becomes a 100K job or disappears entirely because an AI agent writes the boilerplate code better and much faster, that prime borrower simply cannot pay the mortgage. And unlike the 2008 crisis, where the loans were structurally bad because the borrowers had no credit or verified income, these modern loans are perfectly good on day one. They look pristine to regulators, but they become deeply toxic because the underlying income structurally disappears.
so high-end housing markets, specifically the major tech hubs, could face a localized crisis arguably worse than 2008 for that specific income bracket.
That is the tail risk. It is a targeted, rapid deflation in the credentialed class. The people who did everything right, went to the right elite schools, got the right STEM degrees, they are suddenly the ones directly in the crosshairs of this technological displacement.
That is heavy. It really challenges the entire modern notion of what safety means in a career path.
It definitely does. It upends the whole paradigm.
Okay, we have covered an immense amount of ground today. We have the bear case of displacement in ghost GDP, the bull case of the intelligence highway in Jevons paradox, the massive institutional rotation into atoms, and the lurking credit and housing risks. How do we synthesize all this for the listener? What is the actual psychology of the market right now?
I think counterintuitively, you can strongly argue this is a healthy scare.
Healthy. That feels like a massive stretch given the bloodbath we just outlined.
Hear me out. For the last 3 years, retail and institutional investors alike were blindly buying absolutely anything with .ai in the domain name. That was a pure speculative bubble. That was mania. Now the market is finally becoming discerning. It is actively separating the real AI winners from the AI losers.
It's the barbell approach to portfolio construction.
Exactly. Smart investors are tightly holding the builders on one end, TSMC, the heavy infrastructure, the atoms, and on the other end, they are holding the best-in-class agents, Microsoft, Adobe, the massive incumbents who already own the workflow, and the entrenched customer relationship. But they are aggressively dumping the middlemen.
The death of the middle layer.
If you are just a thin software wrapper around GPT-4, or if you are a purely friction-based business collecting a toll, you're getting sold to zero. The market is finally waking up and asking the hard, necessary questions. Do you actually have a durable moat? Or were you just lucky during the zero interest rate era? And there is a deeply human element to this fear driving the market, right? The scare trade isn't just about discounted cash flow math. It's about existential obsolescence.
It absolutely is. People are fundamentally afraid for their own livelihoods and jobs. That visceral fear subconsciously drives market sentiment. When a portfolio manager aggressively sells a SaaS stock, they might be subconsciously expressing a deep fear about their own future relevance in an automated world.
And I really want to end on this nuance. There's incredible resilience in pure human connection. Despite all the endless talk of AI financial advisors and automated planning, people still desperately want a human to talk to about their money.
Skepticism of AI in complex, high-stakes personal finance is still very high. We easily trust machines with small, low-stakes things, play me a song, order a pizza, draft a basic email. But with our life savings, with our physical health, we want a real person. We want lived empathy.
So the widely predicted death of the human in the loop might be vastly exaggerated.
The death of the human is exaggerated. The death of the rote task is not.
That is a profound distinction, the death of the task versus the death of the human. So where does this leave you, the listener? We have this massive divide. Is this the sudden end of the software middle class or the very beginning of a hyperproductive new era?
It is highly likely, both simultaneously. We are actively pivoting from buying the software to buying the infrastructure. The core economic value is violently shifting from the application layer, the bits, down to the foundational physical layer, the atoms.
Which brings us perfectly to our final thought, the concept of atoms versus bits.
This is the critical takeaway I want listeners to really sit with today. In a world where AI can effortlessly create infinite bits, infinite marketing content, infinite boilerplate code, infinite emails, infinite synthetic images, the marginal price of bits rapidly goes to zero. It's basic supply and demand. If you can generate it for free, it's inherently not worth much.
But you absolutely cannot generate atoms.
You cannot prompt a new copper mine into existence. You cannot generate a gigawatt power plant with a large language model. Base energy, advanced silicon chips, massive data centers, hard physical goods, those are strictly scarce. And in fundamental economics, value always, eventually, flows to scarcity.
So the ultimate question for you, for your own personal portfolio and your own long-term career trajectory is simple. Are you long on bits, which are currently inflating away to nothing? Or are you long on atoms, which are the absolute physical constraint of the future?
Are you actively building the hard physical world, or are you just endlessly rearranging the digital one? That is the defining economic question of the next decade.
A completely fascinating, if slightly terrifying, time to be watching the ticker.
It certainly is. There is nowhere to hide but immense opportunity if you know where to look.
Thank you for diving deep with us today. This was intense.
Anytime. Always a pleasure.
And to our listeners, keep your eyes heavily on the atoms. We will see you next time on the Pro Ticker Deep Dive.